Hello, welcome to this video. Today we will be doing a 6-month update of the turtle trading strategy on a small account. Time has flown, so let's get started. So here is an update of the chart, I guess the balance of this account from when we started until now. So the last time we were at this point here, this was April 20th here, and to summarize, right now, as of the last closed trade, we have a whopping 5% return, 5.07% return. That's right here, a balance of $2,054. So this is one of the points of this trading strategy that's kind of tough, because in one of our trades prior to this section, the account was up just over $2,500. So that would have been a 28% return at that point. That said, we knew that the strategy had a tendency to gain profits and to give back those profits. It's just that experiencing that is kind of tough, especially when you see the account doing what seems like pretty well. So anyways, the saving grace is that even though it's had the declines, it's still kind of stair-stepping up, so we'll see if that continues. So let's take a look at the trade recap. We have had these markets that we've traded over the past while, and I'm going to kind of continue from this point onward. One thing to note as we look at this right here, there actually were no trades going on here. This is due to the finance charges that kind of occur in this account. I don't know if it's particular to CFD accounts or how they work out in futures. However, if we kind of look from, actually we could probably get a sum from the beginning. So far we've paid out $278 in financing. Now financing, I haven't looked too much in depth at it, but it looks like when we short something, I'm guessing we have to pay some kind of finance charge on it, and so this comes out of the balance. Now the fact that the turtle trading strategy, at least as per how we're applying it, is a longer term approach, then we seem to just incur a bunch of finance because the trades tend to last a longer time when they're working out. So this highlight here is from when we left off. So let's start here. First of all, we'll just look at we don't need to look at the finance, we'll just look at the orders, order fill, and here we go. We can see here that the April, May, up until June, we only had the trades on, but we didn't exit anything. The first trade that we exited here is silver. So let's pull up the silver chart. And I've kind of drawn it on here. It was a long trade. We got into 2 positions, and after it filled our second unit, it really didn't go anywhere, and it hit our initial stop and incurred a loss. So that is this loss right here, $42. You can see that we have another trade actually that's set up recently, but we can talk about that a bit later. Next we have a copper trade. The copper trade was actually the trade that got all of this started. This trade went from February and closed out in June, so 4 months. So here are the 3 units we entered on, and it started off quite well, retraced, and generally sat there. So you see, while it's sitting there, I guess if we look at it, I'm assuming that we would have actually incurred some positive finance charges. Let's take a look. So for copper, and let's look at daily finance. Oh, so there, with the daily financing, we've also had to pay for this one. So maybe we're always paying finance charges. If anyone knows, please feel free to leave a comment in the comment section telling us how the financing works. It would probably be good if I researched that, but $17 in financing for that trade. So let me take that off again. So that trade ended out closing with a profit of $202. So on our initial opening balance of $1,950, we have a $200 gain there. Percentage-wise, that was pretty decent. At least I felt it was pretty decent for one of the first trades that we did. And as you can see, the trailing stop is this 20 period range, and we stopped out here. Okay, let's see. So that's ticket 554. From here we got into closing. It looks like we closed out this one, the German bond. Okay, so that one closed out June 9th. Let's pull up that chart. And this is a short. I place all the orders on the same day so that I don't have to watch it. One of the things that I have found and I have learned is that when the market gets close to the entry point, then it's probably best to put stop orders in. I have waited before, and what happens is the market tends to just go while you're not watching. Again, I'm not doing this on a regular full-time basis. I literally place the orders and leave it. When I come back to check, I see if things have been filled. So that's kind of what happened most recently with silver. This one most recently placed, this is a Friday, and I was a little bit tentative about placing the orders on a Friday. And what happened on the Sunday when the market opened, let's see if we have this here. The 6th is the Friday, and the 8th is the Sunday. And so the market opened and dropped through our first order, and then within half an hour dropped right through all 4 of our orders and continued down here. So far it's working out. I don't know the best way to do this moving forward, but that said, that's kind of how I'm doing things right now. So back to the German bond. So these orders were placed. We would have got filled on our last unit here. The market went our way and eventually got us out with the trailing stop here. So that would have closed for just a small profit. Yep, that would have been a small profit of almost $4. Okay, on to the next trade. So we left off here, German bond. Now we have the US dollar, Canadian dollar. Still experimenting with this as per a comment. It suggested that currencies are not a good idea for this, for the turtle strategy, because they may not potentially trend enough. I don't know. At this point, I'm still just going to kind of throw them in the mix and see what happens. These are the 4 entry points, and this trade moved our way and eventually got tagged out here on the trailing stop. So Canadian dollar, that closed out with a $56 gain, so not too bad relative to the overall account. Next we have US bond. This one you can see that we have the entry. It spiked up, got us into the trade, and then the following day took us out of the trade. So this one was a little bit rough. I think, as I mentioned earlier, it kind of gets to be like a roller coaster where at some point you have these profits piling up, and it doesn't take much for the market to kind of wipe those out. I think we've seen a few of those earlier, and I think that's the toughest part of the strategy. I think it's one thing to kind of hear it. I think if you've read any comments about it, or read any people's experience with it, I think that's really the big thing. It's not that it's a difficult strategy to understand or to apply. It's really the fact that you need to be able to keep putting on the trades despite the fact that most of them are not going to work out. And what's really good about doing an experiment like this is that you really get a feel for it. So what I hope is going to happen is that over time it just becomes normal to execute the trades, and however they turn out is just really kind of par for the course. You don't really need to get too fixated with whether the trade's going to work out, because just the idea that a few trades are going to make up for it is really what it's about. So that said, it's one thing to understand that intellectually. It's just another thing to watch decent amounts of profits be given back, and I think that's the tough part. What I really do like about the strategy is that it is very objective. With other strategies, there's a lot of, well, is this a trigger? Is this an entry? And it seemed like a lot more analysis versus this, where it's very clean, very clear cut. Here's your entry, here's your exit, here's your risk levels, and you just kind of let the market then do its thing. Okay, on to the next one. We had a wheat trade, and this is another one that I think we got in. The market barely went our way, then it turned around and took us out. So nothing really to write home about here. What I do notice as well is that trades that work out tend to last fairly long. The market starts going your way, and just like the copper trade, you could be in it for a few months. When trades don't work out, they usually just turn around fairly quickly and you're done. Then we have an oil, which also turned out for a loss. Again, entry. Actually, this one is a bit counter to what I said. You see, this one actually went our way, and it looks like it's doing pretty well, only to turn around and close out at a loss. And this was how long? June to mid-July, a month and a half. So that's what brought us back to this current level. So despite all of that, I would say that it's still somewhat encouraging to see the account still step up over the past 6 months. Yes, it's only been 5%, but I think it's one of those things where we're going to have to kind of just wait it out and hopefully catch a trade that generates a more significant amount of return. I mean, I can't really complain for the amount of work and the 5% return. It's not too bad. But that's it for the 6-month update. I hope you guys enjoyed that. If you have any questions, please leave it in the comments, and I'll do my best to answer.